Morning to ladies and gentlemen. A very warm welcome this morning on a Sunday morning. Good to see so many of you here today. I understand that today is the second day of this Singapore Investment Week organized by SIAS. So I'm very glad to be here this morning to share with you a little bit of our, what Ascott Residence Trust, or Ascott REIT for short, what we do at Ascott REIT. So I'll take the next 15-20 minutes to give you a little bit of insight of what we do. This will be the agenda, the outline of my agenda. First, I'll go straight into the business overview. So basically at Ascott REIT or Ascott Residence Trust, we invest primarily in real estate assets, which are immediately income producing, of course, as we are REIT. And our properties are used predominantly as service residence or rental housing properties. Our sponsor, of course, is Ascott Limited, which is the world's largest service residence owner-operator in the world. They manage a total of more than 30,000 apartment units across key gateway cities such as across Asia Pacific, Europe, and the Gulf region. As a portfolio, we own a total of 7,260 apartment units across 24 cities in 12 countries in Asia Pacific and Europe. And we operate under 3 global umbrella brands of Ascott, The Residence, Citadines Apart Hotel, as well as Somerset Service Apartments. In terms of portfolio size, as at 30th June this year, our total portfolio value is about 2.9 billion Singapore dollars, and market cap is almost 1.4 billion as at end of last month, end of July. Our major shareholder is, of course, CapitaLand, which owns about 49% of Ascott REIT. The global footprint, we have a global footprint across 12 countries, as mentioned earlier, 7 across Asia Pacific, namely in Japan, China, Philippines, Vietnam, Indonesia, Australia, and of course our home base, Singapore. And in Europe, we span over 5 countries, namely UK, France, Belgium, Germany, and Spain. So I'll take the next 5 to 10 minutes basically to explain or to give a little bit more detail what really is a service residence, you may ask. So I believe the best way to describe what a service residence is really a hybrid between a hotel at one end of the spectrum and a normal apartment or condominium for rent at the other end of the spectrum. So a service residence, we like to see it as really a hybrid which combines the comfort and the convenience of an apartment, you know, a studio, 1 or 2, 3-bedroom apartments, together with the essential services that you expect, to see in a hotel, such as daily housekeeping, laundry services, as well as limited food and beverage facilities that you will expect in a hotel. So what are the key differences then between a service residence and a hotel? First of all, in terms of the lease structure, you know that hotel typically provides short-term accommodation. So it ranges anything from 1 day to maximum of 1 or 2 weeks at most. And they cater mainly to both the leisure market as well as the corporate market as well, right? At the other end of the spectrum for apartment for rent, we all know that, if you own a condominium, you rent out the condominium, at least the typical lease structure would be at least 1 year or sometimes even 2 or 3 years. Whereas for service residence, for us, our business model, we concentrate or focus mainly on the long stay segment or the extended stay segment. So our typical lease structure, we would like to start anything from 1 month to up to a year. This is really the sweet spot that we are focusing on. And also we are focusing on mainly the corporate market and not so much the leisure market. And because of our business model that we are focusing on the extended stay market, right, on a global basis, our average weighted length of stay for our properties on average is about 4 to 5 months, which is much longer than a hotel, as you can imagine. So this provides a lot more stability of income for service residents or as a REIT. And our properties are not as volatile as for example, compared to a hotel, because for hotel, because of its short stay nature, it will be subject to greater seasonality, which is really tied into the state of the tourism market or tourism industry in the respective countries. And in terms of range of services, for hotels, of course, you will expect the full range of hospitality services. It's not uncommon to see hotels to have multiple food and beverage or F&B options. Some hotels have 3, 4, or even more restaurants, eateries, or bars, for example, right? And over and above that, you will see that the hotel will provide extensive banquet facilities, ballrooms, function rooms, and meeting rooms areas, which you will not find in a service residence, right? In a service residence, you will see perhaps we will offer 1 at most 2 restaurants or F&B facilities that caters mainly to the guests, and not so much to the public, right? And you will not find any of those ancillary facilities which I mentioned earlier. So what happened to those space that you find in a hotel then? All these space are then being transferred and utilized in the apartments themselves, right? So in a service residence, you will find that unlike a hotel, a typical average room size for a hotel is maybe about 20, 25 square meters, for example. Service residence, we have comprised of studio apartments, 1, 2, or even 3-bedroom apartments. And our studio apartments, for example, typical average size starts from 30 square meters to maybe up to 50 square meters. Our 2-bedroom apartments, right, starts from anything from 70 to more than 100 square meters, for example, right? And what cuts across all our apartment units, as distinct from a hotel, all our apartment units will come with fully equipped kitchen facilities. So you can do your own cooking, whether is it light cooking or extensive cooking, because our target market, again, I want to emphasize, is the long stay segment. So people may want to do some cooking, right? And also our service apartment, just like any condominium apartments as well, comes with very well-defined living and dining areas as well. Besides the facilities, in terms of the cost structure, for service residents, our investment cost is always lower, typically lower than a hotel investment cost. And this is, of course, to be expected because for hotel, they provide all the extensive ancillary facilities, which as a service residence, we do not need to provide that. So our investment cost is typically lower than that of a hotel. And besides the investment cost, even at the operating level, the operating cost for a service apartment is always is typically much lower than a hotel as well. A case in point will be staff costs, for example. I just want to highlight, for example, staff costs. For a hotel, average 4-star or 5-star hotel, for example, the average staff to room ratio is at least 1:1. Meaning, for example, a hotel which has 200 rooms, the minimum staffing requirement will be at least 200, right? Because of they have to cater the staffing requirement for the restaurants, the meeting rooms, the function rooms, right? Whereas for a service residence, for example, our staff to room ratio, right, ranges from 0.3 to 0.5, right? It's about half of that of a hotel. So our staff cost is much lower as compared to a hotel. So our operating cost is typically lower than a hotel as well. Okay. So next, I'll just move on quickly in terms of specifically for Ascott REIT, in terms of our sources of income. It can be classified broadly into 3 specific categories. First category is properties under management contract. For properties under management contract, what we do is the Ascott REIT will enter into a management contract with the operator. Of course, in this case, will be Ascott, to manage and operate the property on our behalf, right? And in return, we pay Ascott what we call a property management fee, which is tied to gross revenue as well as gross operating profit as well, right? So in our portfolio, we have a total of 18 properties which are under a management contract arrangement. And as you can see, all the 18 properties are mainly located in Asia Pacific region. The average weighted remaining tenure for all the management contract is about 5 years. The second category are properties that are on master leases. So in this case, in this category, Ascott REIT enters into a master lease arrangement with the lessee. Again, in this case, Ascott. So in this case, we are pure landlord. So every month we collect fixed rental from the lessee, irrespective of the performance of the property. So even if the property experience a downswing, we will still collect a fixed rental a month. So that provides a very stable income for the REIT. So in our portfolio, we have a total of 22 properties that are under a master lease arrangement. Most of them are mainly in Europe, in France and Germany, with 1 in Philippines and 2 in Singapore. And the average weighted remaining tenure for all the master leases is about 7 years. The third category of income are properties that are on management contract with minimum income, right? So this again quite similar, not exactly the same, but quite similar to the first category. The only exception is that in this category, in this category here, the operator provides or guarantees the REIT a minimum level of income. Right, so if the property performance were to dip below the minimum income level, the operator will then have to top up to the minimum guaranteed level. We have a total of 8 properties that are on such management contracts that comes with minimum guaranteed income. Okay, so what are the key strengths of Ascott REIT or Ascott Residence Trust? Are broadly classified into 4 categories. First of all, I believe that one of the key strengths of Ascott REIT is that we have a geographically well-diversified portfolio, right? So while some properties may be adversely affected by the economic downturn in certain countries, this will be offset by better performance from properties that are in countries that are experiencing an economic upswing. So in terms of geographical diversification, I think it's pretty well balanced. The second key strength of Ascott REIT really is arising from our extended stay business model, which really provides us with greater stability of income as compared to other hospitality asset class such as hotels, for example, right? And our income stability is further enhanced by the master leases as well as the management contracts that comes with minimum guaranteed income, because again we are pure landlord, we collect fixed rental or contracts that provides us with a minimum guaranteed income, so we are not exposed to the operational risk for properties under these 2 categories. The third key strength, I believe, is that our high quality assets, because most of our assets are really located in the key international gateway cities around the world, right? For example, our properties are located in very prime location in London, in Paris, in Tokyo, Shanghai, Beijing, Singapore, etc. And lastly, of course, as a responsible manager, we strive to aim to deliver stable and growing distribution to unit holders through active acquisitions, both from our sponsor Ascott, which provides a very strong pipeline of assets in terms of acquisition growth, as well as from third parties as well. We can always acquire not just from our sponsor, but we acquire from third parties as well. Through active asset management, we regularly put our properties through extensive renovation program or other asset enhancement initiatives, as well as active capital and risk management activities as well. So this chart here really provides, just to show you, demonstrate, in terms of the breakdown by countries, in terms of asset values, as well as our gross profit for the first half of the year. So as you can see, in terms of asset values, our assets are pretty well diversified and balanced across the 12 countries, and we are not particularly dependent on any one market in terms of asset or in terms of profit. Our 3 largest market, of course, market of Singapore, France, and the United Kingdom. The balance of income stability and growth, out of a total about 80 million of gross profit that we registered in the first half of the year, right? About 24% of the income of a gross profit comes from master leases, and another 18% comes from management contracts with minimum guaranteed income. So this combined 42% really provide Ascott REIT with the stability of income, right? And as I mentioned earlier, the master leases and the management contract with minimum guaranteed income have an average weighted tenure of about 6 years remaining. This chart shows the distribution per unit or DPU to unit holders of Ascott REIT since listing in 2006. So as you can see, apart from 2009 and 2010, which is really due to the global financial crisis, where we experienced a dip in the DPU, Ascott REIT has delivered stable and growing distributions since our listing. For the first half of the year, our DPU is at 4.52 cents. Okay, just very quick a run through of a brief results highlight for the first half of the year. For the first half of this year, our revenue and gross profit registered a 7% and 3% growth respectively. This is primarily due to additional acquisition or new acquisitions of 2 properties in Japan, as well as better performance of our properties in the Philippines, in China, as well as UK. Unit holders distribution and DPU increased as compared to first half of last year by 2% and 1% respectively, again due to better performance as well as the new acquisitions as mentioned earlier. And RevPAR, or revenue per available unit, which really is the key performance measurement of the underlying performance of our properties. On a portfolio basis, RevPAR increased in the first half of the year by 5% to 147 Singapore dollars per day. Again, driven by higher rates as well as higher occupancies on average as well. In terms of capital and risk management, our balance sheet, Ascott REIT's gearing as at the first half, as at 30th June, is about 39.7%, well within the 60% gearing limit allowed under the MAS Property Fund guidelines. We have always mentioned that we are very comfortable up to a gearing of up to 40 to 45%, so we are well within that level. In terms of debt profile, as you can see, for the remaining months of 2012, we have about 117 million of debt to be refinanced. We are already in very advanced stage of discussion and documentation with several financial institutions, so we do not foresee any problems in refinancing the debt. Nevertheless, we already have, even if we are not able to refinance the debt, we have sufficient undrawn facilities that we can draw down to repay the debt if necessary. So we are very comfortable with our refinancing profile. The chart on the right shows that besides borrowing in Sing dollars, we also borrow in other foreign currencies as well, such as the euros, Japanese yen, sterling pound, US dollars, etc. Right, this is really in line with our business, with our strategy of adopting a natural hedge policy, because we have exposure in other foreign currencies as well. So we borrow in the same underlying currencies as a natural hedge against assets in the underlying countries. In terms of interest rate profile, about 59% of our total loans are on fixed rate, with another 3% on floating rate, but we have entered into an interest rate cap, so effectively about 62% of our loans are on fixed rate basis. Effective borrowing costs for the first half of the year is about 3.4%, and our interest cover ratio is at a healthy of 3.8 times. Okay, my last slide. In terms of foreign exchange, yes, Ascott REIT is subject to foreign exchange movements of certain foreign currencies against Singapore dollars, right, such as euro, sterling, Japanese yen, dong, Vietnamese dong, etc. Right, but we manage and monitor our foreign exchange risk on a portfolio basis. We do not manage foreign exchange risk on an individual currency basis. The main reason is very simple. As a portfolio, while some currencies will depreciate against the Singapore dollars, other currencies will appreciate against the Sing dollars. So there will be an offsetting impact, and we believe that this is the most effective way of managing our interest rate profile. Right, just case in point, out of 76 million of gross profit that is registered for the first half of the year, right, the foreign exchange impact on the gross profit arising from FX movement from all these currencies is only, as you can see from the chart here, a very manageable minus 2.5%. Right, as a strategy, management adopt that this foreign exchange impact on GP should be within a plus minus 3% band. And I'm glad to say that since our listing days, it has always been well within the plus minus 3% band. So we of course we will continue to monitor the FX foreign exchange movement very closely, and where appropriate, we will always enter into the respective hedges to manage our foreign exchange risk. So I think with that, this is my last slide. Thank you. I'll be glad to take some questions later at the panel discussion. Thank you.